given the magnitude of the Challenger grain Christmas layoffs, 172,000, only 62,000 of which were attributable to the public sector in February, we're at about the same run rate. We're running at about 150,000 layoffs announced in the month of March. It's looking like the Fed might get to that 4.4% year-end unemployment rate target by the time they meet again. So I think that the real risk is that Powell's going to have to pivot again in favor of the employment mandate if what we're seeing on the ground with layoffs and, of course, BCY Go bankruptcies running at about a 22 pace for 50 million or more in liabilities on the terminal that you can follow. They're going to have to start paying more attention to what higher for longer is doing to the real economy.
So what is the focus here right now, do you think, of the Fed, Danielle? Is it inflation? Is it employment? How do they balance that these days?
So they're definitely focused on inflation expectations. We saw a fairly dovish voter, Austin Goolsbee, saying we really have to pay attention to see if these inflation expectations become unhinged and start to filter their way into the actual inflation metrics. But we haven't seen that yet. And the fact is, what we're hearing from one company after another is that there's a margin squeeze going on. They are having to deal with higher input prices. There was a lot of stockpiling ahead of the potential for imposed tariffs. Not that we know what they're going to look like yet, but companies are reporting one after another that they cannot pass through these prices to the end consumer, whether you're talking about Walmart or Dollar Tree.
That's interesting, too, because when I've talked to Tom Barkin before at the Richmond Fed, he talked about how he would actually look at the price mix volume when you're looking at a lot of these companies and consumer packaged good companies, whether it's like a Coca-Cola, PepsiCo, Kraft Heinz, and especially what it was meaning for inflation and things like that. What do you like to look at? Because, I mean, you have so much experience. You previously were an advisor at the Fed Bank of Dallas during the global financial crisis. So when you're looking at some of these key consumer type names and what do you think it could mean for inflation? Other forms of growth on the other side of the employment thing. What are you watching there?
So, I think everybody's focus right now is on consumer discretionary. But to Barkin's point and to your point, we're actually seeing the staples come under pressure because of what we've heard from some of the lowest cost retailers out there. And that's that some U.S. households are even beginning to cut back on essential spending. They're moving away from brands. They're moving away from packaged goods, whereas these companies were able to pass through these prices for several years following the pandemic. Now they're hitting a wall. McCormick was the latest to come out and make those types of comments here in the last 48 hours or so. So we really do have to be cognizant of the potential for a margin squeeze here. And that, I think, has to be on the Fed's radar. Again, it is business investment and not consumption. Despite consumption being a record 71% of U.S. GDP, business investment has always led the U.S. economy in and out of its cycles of expansion and recession.